the third webinar in our HTG Financial Fitness for Women series. My name is Carrie Connell, and I'm joined here by my colleague, Allison Donaldson. If you've been with us for the last two webinars, I'm going to repeat the first thing that we say every time, but our firm is very passionate about educating our clients and the community to ultimately lead to a greater peace of mind when it comes to their financial future. In this 5-week series, we're hoping to educate, empower, and motivate you to get started. Last week, we talked about the importance of identifying and setting goals for your family that align with your values so that you can create a plan to achieve those goals. In addition, we laid the groundwork for how to prioritize your goals by understanding the time horizon for the goals and quantifying the cost of those goals. And finally, we demonstrated how one of the keys to achieving your financial goals is to start saving early and consistently. This week, we're going to talk about how to save and how to prioritize your savings so that you can start achieving those goals. We want this to be as interactive as possible. And while I'm presenting the content, Allison's going to be fielding questions through the chat feature in the bottom center of your screen. And we'll try to answer the questions as we go. And we've set it up so that when you ask a question, only Allison and I will see the questions. So don't feel free to ask away. All right, let's get started. After last week's session, you have started thinking about the financial goals for your family and started estimating the cost and time horizon for those goals. And as I mentioned, today we're going to start talking about the ways to save for those goals. Now, there's no shortage of advice and rules of thumb about money and savings. You've probably heard a lot of these. Some of my favorites include save early and often, and you can borrow for college, but not for retirement. Now, you may associate savings with negative feelings or energy because saving money does involve some short-term sacrifices. So instead of focusing on the short-term pain, try to envision yourself with enjoying the fruits of your savings. So for example, when it comes to retirement, try to think about what you might do in retirement and how you're going to spend that money, whether it be playing golf, playing endless hours of pickleball, or traveling to different countries. Or if you're saving for a trip, imagine yourself on that trip, on that beach, on that island, or exploring that city, and all the activities you're going to enjoy. And when you put sort of a value on those activities that your future self is enjoying, that will probably outweigh any inconvenience that you have from saving today. Now, every family has a different set of goals and priorities. And today we're not going to focus on how to prioritize those goals because that's really specific to your family. Everyone puts a different value on different things. So instead, we're going to try to focus on how to prioritize the different ways to save in order to achieve your goals. So that's kind of what our focus is today. Now, in order to understand why all savings vehicles aren't equal, you need to step back and understand how the different types of saving vehicles are taxed. And to keep it simple, I've tried to group the 3 types of savings vehicles into 3 buckets, okay? Now, bucket 1 is what we're going to refer to as our taxable assets. These are, your checking, your savings account, or maybe if you have a brokerage or a taxable account. And these types of accounts are funded with money that you've earned and you've paid tax on already. So you got your paycheck, you've already had the federal and state tax taken out of it, and then you're taking some of the cash that remains and investing it or putting it into these types of accounts. When these types of accounts generate any type of return, whether it be income or interest, you're going to pay ordinary income tax rates on the interest and income annually. Or if you take and invest these assets, if you sell any assets during the year, you're going to pay tax on the gains that you earned on those assets. Now, if you're selling assets in a taxable account, for example, those gains are going to be taxed at capital gains tax rates, which are usually between 0 and 20%, depending upon your income level. Contrast this with ordinary income tax rates, which can be up to 37%. So capital gains rates are a lot lower. Now, bucket 2 is what we're going to refer to as tax deferred assets. This is going to include things like your 401k, your 403b, individual retirement accounts where maybe you're saving for retirement, and deferred compensation. These types of accounts are typically funded with pre-tax dollars. This is money that you have earned, but that the IRS allows you to contribute to these accounts without paying tax on the earnings. Once the assets are in the account, the assets are going to grow tax deferred, which means you don't pay any tax annually until the assets are withdrawn from the account during retirement. When the assets are withdrawn from the account, the IRS is going to ask you to pay that tax, and that tax is going to be at ordinary income tax rates, which is up to 37% in today's tax brackets. Bucket 3 is our, I'm going to call our tax exempt assets. This is going to be include things like Roth IRAs, Roth 401ks, 529 plans, which is what you use for education savings, and health savings accounts. And with the exception of health savings accounts, most of these types of accounts are funded with after-tax money. That's money that you've earned and paid tax on already. But once the assets are in the accounts, again, you're going to enjoy the same type of tax deferred growth as you did in bucket 2. And then you're not going to pay any tax until you take those out. Take those out at the end. Now, you have to take out the assets from this bucket to comply with the usage rules that surround the buckets. So for example, withdrawals from a 529 plan are tax-free if they're used for education, qualified education expenses. Withdrawals from a healthcare savings account are tax-free if they're used for qualified health expenses. And withdrawals from Roth accounts generally are tax-free if you withdraw them for retirement needs. There are some exceptions, but we're going to keep it a little general here. One thing to remember is that buckets 2 and 3 have that advantage of tax deferred growth, which means the IRS doesn't tax the growth or earnings on those assets annually. You don't get taxed on those assets until they're withdrawn from the account. The flip side of that is that you lose a lot of flexibility because you can't withdraw money from those accounts unless you comply with the rules regarding withdrawal. And they're designed for a specific goal. And once the assets are in the account, if they're withdrawn for any other reasons, they may be subject to immediate taxation and penalties. Now, ideally, you want to have assets in all 3 of these buckets when you retire, because then you can do some tax optimization. So you can draw some assets from the tax-free bucket. You can pay ordinary income tax on maybe some withdrawals from your individual retirement account. And then you might sell some stocks in your taxable assets, and you can pay that lower capital gains tax rate. So you've kind of put together your withdrawal that you need to pay for your spending in retirement, but you can kind of minimize the amount of tax that you're paying. So hopefully now you kind of have a basic understanding of how the IRS taxes different types of savings vehicles or accounts. You know that there are different types of savings goals. We've talked about, you might have your paying for college, paying for a big family trip, upsizing or buying a home, or simply a retirement goal. And the key to understanding which savings vehicles are appropriate for a particular goal, you really want to ideally use the vehicle that offers the most flexibility for that goal and minimizes the tax impact. So now we're going to talk about sort of how to prioritize what to save first. And we're going to start with the rainy day fund. Basically, you want to have cash or cash equivalents equal to 3 to 6 months of expenses in a rainy day fund or an emergency fund, so that and this is an account that you wouldn't regularly use for cash flow management. This is just sort of a safe little pot of money that you have. And this is going to be used for short-term cash needs, such as unforeseen car or house repairs, medical expenses, or if you lose your job and you need to replace your income for a number of months before you find your next job. A good example of this is the fund that my family tapped into during 2020 when the oven stopped working and the refrigerator was leaking all over the floor. And I guess my son was doing a lot of bread making, so I guess there is such a thing as like too much bread making, because it did kill our oven and required a replacement. Back in the first webinar, we talked about how important it is to maximize your company benefits. And one way to do so is to take advantage of when the company offers to match contributions that you make to your savings. So the next bucket is a health savings account. Now, a health savings account is an account that you can basically put pre-tax money into it if you have a high deductible health care plan. So a high deductible health plan, there are certain rules, but basically the idea is that you have to pay the upfront deductible before the health plan kicks in. And a lot of people these days have high deductible healthcare plans. In 2022, it means you have a deductible of at least $2,800 and a max out-of-pocket expense bucket of $14,100. A lot of companies now are trying to encourage employees to use these health savings account if you have a high deductible health plan to help pay for some of your healthcare expenses. And so I would encourage you to look and see if you actually have access to one of these. A health savings account is a unique account in that you could put pre-tax dollars into it. It grows tax deferred, so you don't pay tax on any growth. And when you take the money out, it's also tax-free as long as you use it for healthcare. So it's basically money that you've earned that's never taxed. And we could get into sort of the details. Basically, if you're single, you can put $3,650 in 2022. And if you're a family, you can put $7,300 in it a year. We'll talk about this a little bit later in terms of you can also use these types of accounts for as an investment vehicle for your healthcare needs and retirement. The next sort of place where you would want to start saving is to get that matching contribution from your employer for your 401k or 403b plan. Many employers will offer these matching contributions, and you should always contribute to your retirement account up to at least that matching amount, because you're basically turning down free money if you don't do so. The next bucket or place where you would want to focus some of your savings is to start paying down debt. So hopefully, part of your normal expenses is that minimum payment on your debt. But I'm talking about starting to pay down the amount that you owe in bigger chunks. And that's sort of when you'd start after you've contributed and sort of paid yourself in terms of putting money aside for your health savings account and putting aside money for your retirement, then you can put some money towards paying down that debt and start with making extra payments to the highest interest loans that you have. And the next two buckets are sort of filling up buckets 2 and 3. So basically, if you haven't maxed out the total amount that you can contribute to a health savings account, this is when you would do it. And the same with your retirement account. Now you want to put the money into your retirement account to make sure that you max out the amount that you can put into it. In 2022, that amount is $20,500, and it's $27,000 for those of us who are over 50. And if you can afford to pay your healthcare costs out of your current cash flow, the IRS allows you to invest the assets in your healthcare savings account. So if you think about it, when you get to retirement, your two biggest expenses in retirement are going to be basically the house that you live in or the shelter that you live in and your healthcare costs. So saving for healthcare in retirement is going to be a really important thing. So that's going to be one of the biggest costs and expenses that you incur in retirement. The next thing you're going to want to do is, again, keep paying down that debt that you have. Start paying after you've made your minimum monthly debt repayments and you've paid off the higher interest rate debt first. Then you're going to want to start paying down any other debt that you have. And before you start spending more, ask yourself if an item in our experience is a need, a want, or a nice to have. If you think about it, when you buy something, you should think about how long you have to work to pay for that thing. And the cost of anything that you throw, there's a quote that we had in the first slide, which was that the cost of anything is the amount of life that you exchange for it. So if you think about earning the money to pay for whatever item you're buying. Think about how much money it's costing you to buy that item before you incur any additional debt. So if your cash flow can support it, you should also set up a monthly contribution to a 529 education savings account if you have children, and start saving for future education expenses. Even if you start with small contributions, if your cash flow doesn't allow you to put that much monthly into a 529, start early and then start increasing it, because those savings are tax deferred, so you never paid any tax on the earnings on those savings. And then when you get to, if you use those accounts, those 529 accounts for education expenses, they're tax free. And the next bucket, and I've been talking a lot, Allison, so please interrupt me if there are any questions.
We do, and I can save them for the end of the slide if you
okay,
like.
I'll push through. Then have a sip of tea. If the next bucket that you would want to start saving in are taxable accounts. So if you've kind of maxed out your retirement plans and you've set aside money for education, then you can kind of open up a taxable account and start investing some of your extra dollars. And you can also use these types of accounts to save for future planned or unforeseen expenses, such as maybe a child's wedding, or a family or graduation trip, or a new roof. If you know you're gonna have to save money in the next for a big expense like a new roof, you might start saving in a taxable account. And then the final sort of bucket is, if you have extra cash flow, consider making after-tax contributions to an individual retirement account or to your 401k plan if it's allowed. All right.
That last one is becoming more and more of an option we've seen with clients, which is something that if you do have that extra cash flow, so important to take advantage of. So we do have a couple of questions, one regarding health savings accounts and saving for or covering a long-term goal of long-term care needs. If you have long-term care insurance, can you use funds from a health savings account to pay the premium or a portion of the premium?
Go ahead, Allison.
I think that's a fabulous question. And I think the rule is you can use some. You can't pay the full premium, and there are gradations based on age, is my understanding. So you can pay a portion of the premium. It's not very much. It might be a few $100s from your health savings account to pay for long-term care insurance. But it's definitely limited from year to year. And then I think later, Carrie, you're going to spend some time reviewing the maximum that you can save for retirement in each individual account, because we had a question about reviewing that too.
Sure. I have a different slide.
Yeah, so we'll get to that in a few minutes.
All right. Good. So I'll forge ahead. So in the last slide, I briefly discussed a couple of ways for how employers can help employees save for retirement and healthcare expenses. And I wanted to take a minute to sort of dive into this subject because it's complicated. I mean, even yesterday, my little brother called me and he was asking about making after-tax contributions to his 401k plan. And I realized like he's in his late 30s and even he didn't know the basic rules, and he's getting communications from his benefits department, but they're not really explaining his options and putting it in clear terms for him. Many companies are going to offer employees opportunity to contribute to a company retirement plan, and usually that's going to be a 401k or a 403b plan. In 2022, the IRS allows employees to contribute up to $20,500 to a 401k plan. And if you're over 50, you can contribute an additional $6,500 to the plan. This is a catch-up contribution that people talk about. Some employers offer to match all or part of your contribution to the plan to create an incentive for employees to save for retirement. And they really want people to understand, like, this is an important part of a benefit that they offer. And also they want to reinforce, in the old days, companies had what were called pensions. And basically they were forced savings. The company put money that they would otherwise pay employees into what's called a pension fund. And then when the employee retired, the pension paid out an annual payment or a monthly payment to employees that was to serve as sort of income replacement. It was supposed to be their retirement. And they didn't need to save otherwise outside of the pension. But pensions are pretty much gone by the wayside. There are very few companies that still have pensions, and so really the IRS and the way that companies are setting up retirement is really geared towards these 401k plans now. So the way that most of these plans work is that you can either put money in pre-tax, which means you've earned it, but you haven't paid tax on it. Or you're basically deferring paying tax on these assets until you are hopefully in a lower tax bracket in retirement. And the alternative is that some companies also allow employees to make after-tax contributions. So this is money that they've earned and pay tax on, and then they put it into what's called the 401k part of the plan. And if you'll remember you might remember from the last slide, the difference between the pre-tax contributions is that the money goes into the account, it grows tax-free, but then you pay ordinary income tax on those assets in retirement when you take them out. The difference between a Roth 401k is that you put in money after tax. So you've already paid tax on the money that you're putting in. It grows tax deferred. And then if you take it out in retirement, it will be tax free. So there's actually a big incentive to put money in to a Roth 401k. However, it really only makes sense for people who are in a lower tax bracket. So the idea is they're in a lower tax bracket. It makes more sense for them to pay tax on that money today. And they envision that when they reach retirement, they're going to be in a higher income tax bracket. And so that's why they don't want to pay tax on the money then. So a lot of people don't understand. The employers say, oh, you can put money into the pre-tax or after tax. And people don't understand like who should be putting money into which. And of course, it's very specific to your personal situation. But if you're in a higher income tax bracket, chances are you should be putting the money in pre-tax and lowering your taxable income today with the hope that you're in a lower tax bracket today.
Carrie, we have a question about
Sure.
employee versus employer contributions, and then what is vesting? If you could spend a minute on that.
Okay, so to start with, as an employee, if your company has a 401k plan, you as the employee can divert $20,500 of your income into the plan. Now, there also may be an employer contribution to your plan. That's in addition to the $20,500 that you could put in. And that is the matching contribution that we were talking about before. So companies might offer to match a percentage of your salary or a percentage of the contributions that you make to the plan. And again, they're trying to create an incentive for you to save more by doing so. And the second part of your question was about
vesting. So those
vesting.
Employer contributions may not be available to you right away if you were to leave, for example.
Yep. So some companies will put a vesting schedule on their contributions to your plan. So if the company says, okay, we're going to match 50% of every dollar that you put into your 401k plan, they may say, as long as you stay employed at the company for 2 years. So they don't want to do that sort of automatic matching unless you're going to stick around and stay with the company for a number of years. I mean, my son last year worked at Whole Foods for like 2 months, and Whole Foods started contributing to his 401k on day one without him making any contributions. It wasn't a lot, but I mean, some companies will contribute regardless of whether or not you contribute. But most have a requirement that you need to contribute as well.
Yeah. I have a similar story. I did some contract work for a firm, very short period of time. I think I worked for them a week out of, the whole year. And they contributed 2 cents to a 401k for me. And it vested immediately, which was shocking to me. And so eventually I needed to roll that over into an IRA, right? It was just hanging out there.
Yeah. Okay, other types of company retirement vehicles are flexible spending or healthcare savings accounts. And these allow employees to contribute pre-tax income, so money they've earned but have not been taxed on, into the accounts, and to make tax-free withdrawals from these accounts to pay for healthcare expenses. And the difference between the two is a flexible spending account is a use it or lose it type of account. So if you don't, you need to use all the money that you contribute to that account by the end of the year. Whereas a healthcare savings account is not a use it or lose it. And you can actually accumulate assets in a healthcare savings account, as we mentioned in the last slide, and use them for healthcare expenses in retirement or at a different period in your life. And then there are also pension and deferred compensation accounts. And these are vehicles that allow employees to contribute pre-tax income, invest the assets, and then they defer the taxation on the assets until retirement, or in some cases when an employee leaves the company. So there are a lot of different ways that companies have created to help you start saving for retirement and healthcare needs, or to defer income into periods where you might have lower income tax bracket. Now, even if a spouse does not have earned income, a spouse may be able to contribute to a retirement account based on their spouse's income. And so what these are often called are spousal individual retirement accounts. And there are a couple of different types of accounts. There's a Roth IRA, where contributions are made with after-tax money, so money that has been earned and taxed already. But again, the assets are going to grow tax-free and will be tax-free if withdrawn in retirement. Now, they're great accounts, but there are restrictions. So you can only contribute to a Roth IRA if your income is under a certain dollar amounts. For a single person, it starts to phase out if you make over $129,000. And if you're married, filed jointly, it starts to phase out. Your ability to contribute to these type of accounts starts to phase out over $204,000 in 2022. But there also are accounts called just regular individual retirement accounts. And these accounts you can make contributions to on a pre-tax basis if your income is under certain dollar amounts, or you can make after-tax contributions. And the benefit is, in both cases, that these assets are growing tax-free and won't be taxed until they're withdrawn in retirement. And at which point, you'll have to pay tax on ordinary income tax rates. There's another sort of tool that a lot of people are using, which is called a backdoor Roth strategy. And I'm going to just cover this tangentially because there are a lot of rules and I don't want anyone to get confused by it. But the idea is that if you don't have, you as a spouse don't have any other retirement assets, you don't have any other individual retirement accounts, you make an after-tax contribution to your spousal IRA, and then you flip that money immediately into a Roth IRA. So then you get the benefit of that tax deferred growth in the Roth IRA, and the money will never be taxed when you withdraw it. It's called a backdoor Roth strategy, and it's something to look into if you're eligible to do so. And then finally, of course, if you're a spouse and you have extra cash flow, you can open up a taxable account and start saving in a taxable brokerage account and invest the assets and try to grow and basically earmark those assets for retirement, even though it's not a retirement account. So I promised I'd sort of briefly touch on some of the contribution limits for all of these types of accounts. So a traditional IRA, which we were just talking about, is like, for example, like a spousal IRA, you can contribute 6,000 in 2022 or 7,000 if you're over 50. The same with a Roth, it has that same contribution, max $6,000 or 7,000 if it's over 50. If you're looking at a 401k plan, we talked about it being 20,500 plus an additional 6,500 if you're over 50. And this again is independent of how much your employer contributes to that portion of the plan. And then if you're able to put after-tax dollars in, the amount is up to 61,000 or 67,000 if you're over 50. But that amount actually does include employer contributions. So there's some caveats around there. And then of course, one thing I'm not going to get into, but there are also retirement plans and types of accounts that are available if you are self-employed. So a lot of people may not be working full-time for a company. They may not be receiving, they may not be considered W-2 employees, which means they're receiving a paycheck from a company. Maybe they do some consulting like Allison mentioned. So they're working, part-time for a company doing a project and they're being paid, but they're not an employee of the company. You can still use, in some cases, use those earnings to make contributions to retirement accounts. And one of them is called the Self-Employed Retirement Plan. It's often referred to as a SEP. And you can contribute up to 58,000 to a SEP in 2022 if your income, it's based on your amount of income that you earned, but it's up to 58,000.
So we have another question regarding Roth contributions. So if an employee earns more than the limit where they're not eligible to make a Roth IRA contribution, is the next best thing contributing after-tax dollars to a 401k if you're eligible?
That probably, I'm going to say it depends. Like any good economist, the answer to all questions is it depends. It really depends on what income tax bracket you're in. So in other words, and what income tax bracket you expect to be in retirement. So if you're today in the top tax bracket, it probably doesn't make sense to put money into a Roth 401k. In other words, use after-tax dollars to contribute to your 401k because you're paying the max tax today. And you're better off basically taking the tax deduction for that contribution in 2022 and paying the tax later. But again, it's a very specific to any individual. So it's a hard question to answer without more facts.
Yeah. But there is a tax optimization strategy where you recognize income when your tax rate is low or relative, and you defer income when you're in a higher tax bracket.
All right. Oh, this is I saw this chart the other day. I liked it. I thought maybe I'd incorporate it into here. With the message, don't stop saving in good times. So one thing that you need to remember is to separate your savings goals from what's going on with the economy at large. If you have a goal, you need to treat it as a goal, regardless of what's going on around you. In other words, don't party like it's 1999 when the economy is humming along and let your spending get out of control. And this chart sort of shows that the annual average savings rate in the US, family savings rate. And as we talked about before, ideally a family should be saving between 10 and 15% of their annual income for retirement. And this chart sort of shows how savings rates tend to increase during times when the economy is contracting or in a recessionary period. You could see the big outlier would be 2020 with 15% savings rate actually being achieved by the average American. And then it drops back down when the economy starts expanding. So when people feel like the economy is in good shape and they're in a good position is when they tend to save the least. So just try to remember that, sort of separate your savings from what's going on around you. All right, so now we reviewed the best ways to save, to maintain flexibility and sort of minimize the tax bill. But you may ask me, where do I find all this extra cash to save? And it's a good question and one that I can't necessarily answer for you personally, but I thought I'd just save some sort of general savings tips and tricks for you to consider and think about whether or not they might apply to your family's financial situation. So step one is probably to go back to something that we talked about in the first webinar. No one likes to think about how much they're spending, but one of the main reasons to track and understand your spending is to make sure that it aligns with your goals. So if you understand how you spend, it'll help you identify ways to save. So our first sort of tip is a very common one called the 50-30-20 rule. And this rule recommends that you divide up your after-tax income, your paycheck basically, and allocate 50% to your needs, 30% to your wants, and 20% to sort of savings and paying down debt. This is just a general rule of thumb. It could be that your needs make up 60% of your after-tax income, and you may have to reduce the amount that you attribute to your wants in order to still achieve your savings goal. And on the flip side, you might find out that your needs, as your income rises, that your needs are less than 50% of your after-tax income. And you should consider whether you can increase your savings rate rather than increasing the amount that you spend on things that you want versus need. The second tip is to make your savings automatic. So the idea here is if you never see the money, it's going to be easier to save it. So you start with setting up your monthly 401k, your company retirement plan contributions high enough to ensure that you max that employer match. And if you're trying to save for another goal, maybe building an emergency fund or planning a trip or buying a house, whatever it might be, have a certain amount of money from your paycheck go directly into a savings account instead of into your checking account. And that will sort of force you to save because you'll never have the money to actually spend, even though you know where it is and it's accessible. And another thing that people do is they rely on this sort of end of year annual bonus payment. And I have had clients before who, they use that bonus to kind of pay back everything they spent during the holidays, for example. They figure, the timing works out, go a little hog wild on holiday spending or trips, and you get that bonus in February and March, and you pay off the credit card bill, and you're back to zero again. You got to remember that bonuses for most people are discretionary; they're not guaranteed, and you really should try to resist the spending the bonus before it's paid. And also maybe even consider banking all or part of your bonus, saving it. And take a similar approach if you get a salary increase. For example, if you get a 5% salary increase, maybe increase your savings goal by 2% or 3% and allow yourself the ability to kind of spend a little more with that extra salary increase, but also try to avoid sort of that lifestyle creep, the idea that every time your family income increases, your spending increases by the same amount, or hopefully not more. So consider trying to save some of your bonus or all of your bonus and some of your salary increases each year. Also understand and sort of own your debt. Track your debt that you have, know the interest rates that you're paying on that debt so that you can prioritize paying it back. Make sure you look for opportunities to lower the cost of your debt if you can't pay it all off. For example, millions of Americans refinanced their mortgages in the last couple of years to take advantage of lower interest rates that we've been experiencing, record low interest rates. If you're one of those families, examine where that savings that you have, you've lowered your mortgage from 4% to 2%. Now you've got an extra 2% each month. Figure out where that's going. Maybe that's an opportunity for you to save more or pay down your mortgage, whatever it is, and even though you don't have to pay that monthly amount, higher monthly amount to the bank. The next is takes a little bit of thinking about it, but if you think about your every paycheck that you get, 6.2% of any money that you earn goes to pay into the Social Security Administration, so that hopefully when we get to that point where we need or would like to have Social Security, there will actually be some money left in the system for us. And if you're fortunate enough to be earning a higher income, know that you only pay that 6.2% up to the point where you earn $147,000 in 2022. That's the amount. And after that, you don't pay into the Social Security system anymore for the rest of the year. So if you know that your income is whatever, 300,000 in 2022, somewhere around, June or July, you no longer have to you no longer will be contributing that 6.2% of your paycheck to your Social Security. And you're going to have an extra 6.2% in your paycheck every month. And you could sort of earmark that for savings, because you were able to make ends meet during the first half of the year. So maybe you can not spend that money in the second half of the year. I'll admit that one will take some discipline, but it's worth trying. I guess the other thing, we talked about before is, have specific target savings goals. Set realistic schedule for achieving those goals. It's one thing to say, I'm gonna save $100,000 this year when, you're only earning, $125,000. That's probably not a goal that you're going to be able to achieve. So try to set achievable goals, dedicate savings to directly in, money that you're earning directly into those savings goals. Give yourself visual reminders of those savings goals for why you want to save. If you're saving for a vacation, put a picture of that beautiful destination on your refrigerator so that you're reminded of it over and over again, to sort of give yourself an incentive for saving for that goal. And also sort of regularly check yourself and see if you're meeting your savings goals. And the one thing that I really would recommend strongly is try to never borrow against your retirement accounts. Once that money is designated for retirement and put into a retirement savings vehicle, try to never, ever tap into it until you are into your retirement age. Employers have really made it a lot easier for people to take loans against their 401ks. Please try not to do so. Just do so only as a last resort, never to fund current sort of wants, only needs. Because when you take money out of a retirement account, you're borrowing against your future self, and the assets that you borrow aren't growing while they're not in the account. So even though, they've made it easy to take that loan, the interest rate might be relatively low compared to borrowing from an outside lender. The assets aren't growing while you're borrowing against yourself. That makes sense. And then the last one is, pundits will tell you, and I certainly haven't mastered this myself, but you should really, avoid shopping at night. You should, if you're going to shop, you should put things into they say put it into the shopping bag in the cart, right? But don't actually push the buy button until a specific morning. Like they say, okay, Friday mornings at 10 is when you should make all your online purchases, because that gives you time to sort of think about whether you actually needed it, instead of and kind of delay that decision to make sure that you make a positive buying choice.
I love that suggestion. How many of us have swiped the buy now after having, half a glass of wine? Maybe we shouldn't do that.
I think also my mom really ingrained to always buy things on sale. And so I will buy things on sale because they are on sale rather than because I need them. And my kids know that if they say it's on sale, that mom will say yes. Right. And it's awful. And they're like, but mom, it's on sale. I'm like, oh yeah.
I love that.
Try to break yourselves of those sort of habits. And, I think all of us, particularly if you had nothing to do during the COVID lockdown, you started looking around your house and you realized how many things you could get rid of. And, think about all the things that you buy that you don't actually need. And if you really want to take it to extreme, there are some people that say, any big purchase you should do a 30-day delay on. I think that's a little harder, but 24 hours, 48 hours, that might be easier to achieve. If you really want to save.
This is a fabulous list of tips and tricks. I love it. And the banking the bonus or half of any salary increase and the save the extra 6.2% after you've reached that Social Security limit. Those are it's such easy things to implement, and you're not even going to miss the money because you're not used to having it. I love that. Those were great suggestions. We have one question. Housing is often one of our biggest expenses. Is there a general rule or formula for how much we should be spending on housing or rent? As a percentage of our take-home pay, perhaps a percentage of our gross income.
I mean, that's a hard question, particularly where we are right now, right? Where the cost of housing is so high relative to a lot of people's income. It's really, it probably depends more on where you live. I mean, I know the old adage is, right, a third of your income should be going towards housing and no more. And that's a difficult question to ask, because perhaps you're living in a more expensive area because you're taking advantage of the public school system, for example. So I don't know, Allison, if you have anything else to add. 1/3.
Yeah, I mean, I would just say that general rule of thumb, 1/3 of your take-home pay. But as you say, that's often hard to do. So something else has got to give, right? If you're spending more than 1/3, you have to take away something else.
And you have to weigh the pros and cons of doing so.
Right.
Maybe it's that, public school education, in New Canaan is great. So you're willing to pay a little bit more to live in New Canaan or some other town, or maybe.
Right. Yeah. Right. Very good. So we have time for more questions if anybody has any. Other than that, we just thank you for joining us today. Carrie, you did an awesome job laying out different savings opportunities. The ones we covered today are the most common, I would say. There are certainly others, but some easy tips and tricks, which we all appreciated. We'll follow up tomorrow with a recording of the webinar. Feel free to forward it to anybody you think might benefit from listening to this information. And we have 2 upcoming additional sessions to finish off our series. Next week's session, we cover investing. And then the final week, the final Tuesday, is on teaching healthy financial habits to your children. So 2 really exciting topics coming up. We invite you to invite your friends, tell your network about the upcoming webinars, and we'd be happy to have them join us. So thank you all. I don't see any more questions coming in. Thanks so much, Carrie. This was